This is Tom Aspray with the Viper Report Market Wrap video for the week ending March 21st. Well, it wasn't exactly the week I was looking for in my commentary on Forbes or in the last video. I was looking for a strong close to suggest that we would at least see a couple of week rebound. For example, back to this 20-week EMA for the SPY at around 582, or it would be the start of a resumption of the major uptrend. For the week on the NYSE, the AD numbers were positive, but sort of a mixed bag. If you look at the AD line here, we still have this divergence. High in the S&P, higher high in the S&P, lower high in the advanced decline line. Based on the moving average, it's still above its EMA, but it's fallen below its weighted moving average. Why is that important? Well, when I created this in the early 80s, I preferred a weighted moving average. Of course, I don't have that option on stock charts, so that's the rub. But, more importantly, we have the support line D. A breakout of C or D is likely to signal the next major move. On my Forbes page, you can see the last article, 2 stock market shares for the week ahead. And oftentimes when you see such an extreme oversold condition that we saw a week ago, you can have a pretty good judge of what important can happen next. Overall, looking at the averages, the Dow, Gold, and the New York Composite were all up 1%. Not too bad. Even the Russell was up a bit more than the S&P's half a point gain, while the Nasdaq 100, one that really needed to see a 1% gain, was only up a quarter, and the Nasdaq Composite was even less. So you can read this whole article. If you want to see any of my past articles, you can see, we have archives here, going back to forever. Anyway, pick a time in history, you can see, the good, the bad, and the warts. If we look at the New York Composite, you can see up 1.16%. It's holding pretty nicely. No divergences, because here's the high in the NYSE. The AD line made a high, stocks only, below its moving average. Rose a little bit last week, and the volume was pretty good. So, it still favors an upward resolution. It's just taking a little longer than we thought. Now the deadline at April 2nd for the trade tariff nonsense, has moved it out a little bit more. You can see that the NYSE all, is very close to moving back above its moving average, like 100 issues or so. In last week's survey from the AAII, slightly more bullish, 21%. It's been 19% for some time now. Of course, this goes all the way back, into 2005. And we can look at it a little closer here. Stock charts does make this quite easy. So instead of looking at the 20 years of history, we'll just look at the last 2 years. And you'll see a much different perspective. You can see, that it's turned up from below that 20 level, currently at 2160. And the spread, this is the bullish percent minus the bearish, is down, in minus 36. So that's an extremely oversold. Recent data from Investors Intelligence, which is another group that they survey investment newsletter writers. It showed a similar imbalance. Newsletter writers are now quite bearish. That's a positive sign. It's a contrary indicator. While the weekly chart could still go either way, the daily deteriorated late in the week. You can see this is the S&P 500 80 line, still bumping into this resistance at line 8, dropped back below its moving average. So, has key support at the early March lows here. If we break that, then we all go back to December and early January lows. Stocks only here in red looks even worse. It's got clearly a downward pattern and also closed below its daily moving average. And stocks, they all NYSE AD line, slightly better because it's still above that little high, but still in a downward trend. So what about the Nasdaq 100? Well, the Nasdaq 100, the QQQ closed at 40.84, still below the yearly pivot at 41.91. Usually, if a signal is not reversed in the following week, it suggests that the signal is more valid. So that's the case right here. We're looking for a slightly higher close to suggest that the last week's close below the yearly pivot was a whipsaw negative signal. AD line still does not suggest. You can see that, whereas the Qs are way back in here, AD line is still in an uptrend, line C. Okay, so obviously we break below that, the recent low, that'd be different. Relative performance on a daily basis is still negative, but it's also back to support. Looking at the action late last week, broken down by averages. So this shows that on Friday, 39% of the S&P stocks were lower. Not a great sign. S&P 1500, 39 also. And then for the Qs, a little bit better, just 9. This big burst of upside momentum, would oftentimes have some carryover on the upside. So, that's not the case right now, and I think it's got to prove itself on the upside early next week. Let's look at some of the other indicators. The VIX and VXN, when either of these are rising, it's usually bearish for stocks. You can see we had a breakout here. End of February had a nice run to the upside, and that run seems to be over. It would take some quite heavy selling to get it back above its moving average, and then of course if we move above this peak, that'd be very bearish. But that, my following of this shows, like I mentioned, it was an anemic rally, so I think that the recent decline is probably legitimate. We looked at the high-low data last week, and we saw some positive or encouraging signs. A little less so this week. You can see still low number of stocks making new lows. That suggests that this rally has not been impressive so far. You can see back here in May of 24, we had a much more positive trend. The new lows, had been declining, so that was encouraging. We have a divergence, this line C. They popped a little bit on Friday, so we'd like to see the new lows on early in the week drop below this 180 level. If we look at the NYSE Composite, it also shows a pop here in the new lows, but still a trend of lower peaks in the number of stocks making new lows. That's a sign generally that, each decline in the market, was less negative because fewer stocks were making new lows. Now we need to see a pickup in the new highs, above 100 would be the first, and then above this peak here, which I think is around 150 to 160. So stay tuned on that. Something you're learning about the markets, and I teach, that's something should be on your daily watch list. As for the growth value analysis, remember this is a ratio of IWF, a growth, it's based on the Russell 1000 growth ETF, and IWD is the Russell 1000 value. So, when this spread is going up, it's bullish for growth. When it's going down, it's bullish for value. So we closed below the uptrend here. I've been talking about these lows right in here. If you were going to break those lows, then we could start make the case of a, sort of a double top. Those of you who are not follow this information, slight pause there as I had to find the long-term chart. So this goes back to 2000, okay? Tech stocks, the dot-com bubble busted open here in March. And so all this decline, in the market from 2001, overall, that most stocks bottomed here in 2003 and had a new rally in terms of other averages, but that was not a growth rally. You can see that, as the value started to top out, banks, etc., growth took over, and it's been pretty much a growth run, since that point. And it's still, this is a monthly chart, so month's not over yet, so, it doesn't really, look as negative as the weekly. So, a side note, if you have any, I know some of you are just getting started in the markets and other have been there a long time. If you have any topics or anything you would like me to discuss or do a short special video on, drop me a line at tom@viperreport.com and tell me what you're thinking and what you'd like to learn more about. The decline in that ratio, you can see that the IWD, the value component, was up 0.98% last week, but if you look at the growth component, it was only up 0.3%. So that's a 0.6% differential, which can make a difference. One last thing on the markets before we go on to the sector and watch list. This is a chart of the SPXL, that's the triple long leveraged. You can see it 90-minute or 260 minutes rather. Gave a positive signals here, but it's been very choppy. Oftentimes you'll see this choppiness before a major move. So this is the rally from last week's lows. If you look at this on a daily basis, you can see it's still on the sell signal from back here on the 24th or 21st. And, this kind of pattern in here does not look great. You can see we have all these tails, so if you're new in charting, when you see that either above where we close or below, like right down in here, that suggests that buying was coming in at those levels. Well, this indicates selling is coming in. So it's still, on that negative signal here, and, suggests we could see a drop back to or below those lows. I think we should know something by early in the week. On to the ETF report. One new weekly buy signal in VDE, that's the Vanguard Energy, similar to the XLE, which we are in for the Viper ETF clients. Not a lot of other signals on a weekly basis. Some daily positives on both the ARCs at the end of the week. That's interesting. Overall, we scale down here, so 38.9% are above their quarterly pivots, so that's typically in the correction camp. We like to see it above 50 or so. Growth gauge is still lagging. You can see only XLV here is positive. And, in terms of the value, we have RPV, which is a value very similar to the IWD. XLF and XLE are positive across the board. And we have some other ones that we're watching there. And, of course, still, the short ETFs, only TZA turned negative, so that's a bullish sign. And, TNA, which is the triple long, it flashed a daily DTS. Of course, more interesting is often the sector report. That's the same here. You can see we've been featuring these relative performance. Those of you who are not familiar with relative performance, on the our YouTube page, there are a number of articles on that. And once again, if you want a refresher course, this is sort of so this is the fast moving average and the slow moving average. Pretty bullish. We were pointing out last couple of weeks, and you can see that there's a number of a little more green here on the energy. PSX did a daily DTS on Friday, but the rest is green. And Chevron, Exxon Mobil, closed back above its quarterly pivot. That's all good. So materials, the chart still looks okay, but not really seen a lot here. So we've had Newmont and Freeport McMoran. Copper play is coming into because it's going to be protected or want to resume the copper industry. Of course, the realities of those is, I don't know, it takes what, 10, 15 years or something, I think, to get a smelter. Having worked in a copper smelter in my youth, it's not a great job to have, I can tell you that. It's they check you for lead poisoning on a regular basis. Industrials, of course, Boeing got the big contract last week, so the defense parts will look a little bit better there. GE still strong, Deere, and not so much in the airlines. So it'll be interesting to see whether some of these start to come to the forefront. 33% there positive. Still lousy is the consumer discretionary. MACD or MCD rather. McDonald is positive across, as are Orly and AZO auto parts, but 25% the sector is still a laggard. Consumer staples, it seems to be weakening. So is this a pullback in the uptrend? You can't say at this point it isn't. So you'll be watching to see if some of these like Philip Morris and MO, whether they turn, these daily negatives turn into 3 days, Coke, Mondelez, etc., Dollar General. So I'll be watching that. Clearly it's a defensive sector. Healthcare, 41.7. I'm surprised the chart's still, maybe topping out here. We kind of cooked down a little bit. But, United Healthcare, which was just, trashed not that long ago, it's new 3-day and weekly, so that's a good sign. J&J, the other big holding in most of the healthcare ETFs, also looks good, as does Bristol Myers, so it's been a bit choppy. Let's further down, financials. It's a real interesting one. 18.2. That doesn't look very good. And then you look at this relative performance chart, it looks much more positive. So that's quite interesting. You can see that, in the stock report, we got lots of bullish doji, weekly doji signals, including Goldman Sachs, Citicorp, and I think Morgan Stanley. So that should be interesting. Once again, you can see these 3 days, Bank of America, Wells Fargo. If they flip into 3 days, that would be a good sign for the financials. Technology, 8.3. That's, Intuit and Cisco, Nvidia, is still, looking pretty weak. Looking at the daily chart of Nvidia, it's kind of holding firm here. So, certainly the sentiment's pretty negative on it, which is a switch. So really clearly defined support, at 114.54 down to 112.88, and resistance, back up here at 122.89. So, if you break out above that level, you could easily run to the 130, 136 to 140 area. Communications holding right at 50%, though the chart's looking a little more vulnerable. So the next rally there will be important. Comcast, a 3 DTS, Charter Communications also, Electronic Arts, etc. So kind of a mixed bag. Only 50% are of weekly buys and 50% have 3 days. So we'll be looking for some changes there. Netflix is improving there, so if it can get into the 3 day, I heard a bunch of people recommending it. That could maybe help the whole the XLC move back towards its highs. If it gets back to its highs, though, I would watch it closely. And utilities 75%, and retail, also quite positive at 50, but not too impressive. As you can see, a lot of the REITs are still green here. Wrapping up, looking at the themes report, we'll kind of start at the end. Dow, some interesting signals there. It's performing a little bit better. Its AD lines do look better than the other markets. So, but you can see, We have, both the Visa here, all red. Of course, I said McDonald's, Amgen, and then Home Depot, and Lowe's are also kind of on the cusp. Microsoft is trying to turn back around. Q's largest, lots of red. As you can see, Meta's about the only thing that's green. Oil and gas looks a lot better at 80%. So it's really a feast or famine. Aerospace defense, 75%. That's pretty good. Of course, added with Boeing there, and some of the like the ITA, which is an aerospace ETF and defense ETF. Infrastructure, 89. Hotels, 0. Retail, 16.7. Costco, of course, is being kind of trashed, and Dollar General about the bright spots here. But be watching, for a daily buy on Costco next week. Air transport's not great at 40. Ground transport's at 0. And electric utilities, 100%. So, it's still a market in search of a bottom. So watch the AD numbers early in the week for signs of more serious selling. Of course, we're waiting for some stronger signs from the AD line before aggressively long, though basically we are on the long side. Recently, added XLE to the trading portfolio, and I'll be posting the current holdings on Monday on the Viper Report website. Viper ETF, Viper Hot Stocks, and we're working on scheduling for training in the second quarter. If you do want to learn more about the markets, and most of my students will tell you that they've gained a whole new perspective, and all the commentary they read is taken with a much different spin, and it's really improved their performance. Of course, no guarantees, but I think you'll find it beneficial. So let's tune in next week. We'll have another video, and hopefully you won't need Dramamine for the week ahead.